If you've been trying to learn how to trade, there's no question you've spent a considerable amount of time studying how to read candlestick charts. And don't get me wrong, candlestick charts are critical. I cannot trade without them. However, like anything else, they do have some limitations. And one of the big limitations of candlestick charts is that they are a historical record of what has already happened. In other words, they're looking backwards. But what we're trying to do is predict what's going to happen next. Now, when we study candlestick charts, we're looking for traditional candlestick chart patterns where we can begin to see the formation of the pattern and therefore predict that if this pattern resolves the way we expect it to, this is what's going to happen next. But what if there were a tool that you could use that would help you very definitively predict what will happen next? There is one. It's called using level 2 market data. And when you combine level 2 market data with the historical context of a candlestick chart, that's where the magic happens. Now, whenever I'm teaching people how to day trade, I always start by teaching the basics of how to read candlestick charts. That's the foundation. And once you've got that down, that's when we take it to the next level and we add this new layer, which is learning how to read level 2 market data. So what exactly is level 2 market data? Well, what you see on my screen right now is the level 2 window for Bank of America. This is a very popular stock listed on the New York Stock Exchange. And what the level 2 is displaying are all of the buyers and all of the sellers. And right next to the level 2 is this little window here, which is showing us what's called the time in sales. This is a record of every single transaction that goes through the market. And so what's very interesting here is that these are just numbers. This is, without context, not something you could trade with. You can't trade just on these numbers alone. You can see the current price. What you can see is on the left, there are people that are bidding to buy at $43.42. And on the right, there are people that have an offer posted to sell at $43.43. Therefore, we have a 1 cent spread between the bid and the offer. Now you can see the price goes down for a moment, then it comes back up. And as that's happening, actual transactions are going through the market. So the level 2 is very dynamic. It's moving. But let's add context. So we need that candlestick chart to give us the big picture. So this is the candlestick chart for Bank of America right now. All right, so this is our 5-minute chart right here in the center. I've got my 1-minute chart over here on the right. I have a 10-second chart down here at the bottom corner, and I've got a daily chart right here. So these are the charts that I'm using to actually identify and look for patterns. But once I've identified a pattern, and let's say I'm thinking about buying this right here, what does the level 2 really do for me? Well, let's think about it for a second. If I was considering taking a big position right down here, what is something that I certainly would not want to see? I would not want to see, let's say, for example, someone selling 1 million shares at $43.41. Because if I saw that really big sell order, what would that communicate to me? That would communicate weakness, bearishness. Someone wants to sell a huge position. And until someone else has bought all of those shares, the price is not going to go up. That person, in other words, is sort of blocking the price from moving higher. He's putting a real lid on it. So we might love the candlestick chart pattern, but then when we add level 2 market data, we can see that, we can't take this trade because there's a big seller. Or maybe inversely, we pull up the level 2 market data and we see that there's a 1 million share buyer right down here at $43.40. And what does that communicate? That communicates strength. That gives us now conviction that there's someone else in the market that likes this setup a lot. And if we jump in right here, we're getting in just ahead of someone who has a big order out there who is creating support. So big orders on the level 2 can create support and resistance. Now, these are orders that have been placed but have not yet executed. So candlestick charts tell us what has already happened, whereas level 2 is helping us understand what is about to happen. simply by looking at the presence of big orders either on the bid to buy or on the offer or the ask to sell. Now, I remember the first time I pulled up a level 2 window, I was overwhelmed. I saw all these numbers, I saw a lot of things moving, a lot of colors, and I couldn't figure out what was going on. So I can relate, and that's why I wanted to make this episode for you. And what I'm gonna do to make it really simple for you guys to learn is I'm gonna break level 2 down into its most fundamental components that you need to understand so you can start utilizing this tool in your own trading starting today. Because I'm telling you, if you're trying to trade and you're not using level 2, you're at a disadvantage. It would almost be like trying to drive by just looking in the rearview mirror. Because remember, the charts are the historical context. So yes, looking in the rearview mirror, yes, you can understand relatively what's going on, but you gotta be looking forward. And level 2 to me is like looking through the windshield because that's where I'm seeing all the buy orders and all the sell orders. So that's what's helping me predict what's gonna happen next. So in today's episode, I'm gonna give you a fantastic demonstration of some trades that I took. I'm gonna make about $30,000 in this live trading archive, and I'm gonna break it down, slow it down, and let you really see the signals on the level 2 that gave me really the indication that this was gonna move higher or that it was gonna stop moving up and I had to get out. This is some really exciting stuff. So let's go ahead and jump on the screen share. We've got a lot to cover. Now, this is the candlestick chart for the demonstration that I'm gonna be giving you. The price is currently up 172% on breaking news. Okay, this is fantastic. This is exactly what we like to see. But just to get, take a big picture, look, how do we even find these types of big moves in real time? Now, as I was editing this class, I realized some of you guys might like a PDF resource, sort of a cheat sheet of notes to go along with everything that I'm teaching today. So what I'm gonna do is I'm actually gonna put a link pinned to the top comment and in the description where you can download a series of PDF resources, including my stock selection criteria, the 5 pillars of stock selection that I input into the scanners to help me find stocks in real time. And I'm also gonna include the PDF resource for my technical analysis strategy and my small account strategy, which I think you guys will really enjoy. So make sure you guys check those out. I just want to say that before I forgot. Now let's go ahead and jump right back into it. I'm using scanners, and these scanners are hunting for volatility because that's the strategy that I trade. I've learned that I don't make money buying something at $5 and selling it at $5. I make money buying something at $5 and hopefully selling it at $6, $7, $8, $9, maybe even $10 a share. Goes up 100%. That'd be fantastic. Now that doesn't happen every single day, but it happens more often than you might guess. And so my focus each morning is searching the entire market for volatility. And typically, think about it. Why would something go up 50% or 100% in one day? Typically, it's because it has some type of breaking news catalyst. So on this particular day, we've got FRGT, which at 7:14 in the morning, and this was Eastern Standard Time, was already up 88% on 15 million shares of volume. This thing is moving and it's moving quickly. So once I see it moving, what's my next step? Well, I evaluate it based on the price, how much volume it has, the float, which is the number of shares available to trade. And by the way, it doesn't matter whether you're trading cryptocurrency, you're trading futures or Forex, you can be trading really any market, and you can pull up candlestick charts and you can pull up level 2 market data. However, some markets that have a lot more volume will be a lot easier to read than a market that has very little volume. So that's worth noting. So once we've identified that this was the leading percentage gainer in the entire market, there was a really good chance a lot of other active traders like myself would be focusing on it. So then at that moment, we pull up the chart and we begin to ask ourselves, where can I buy this? Is there a way that I can manage my risk while still participating in the momentum that this is experiencing? By the way, for those of you guys who are longtime subscribers here on the channel, you know we're about to dive into a full-length training, so I hope you hit that thumbs up. And for those of you guys who are brand new to the channel, my name is Ross Cameron. I'm a full-time trader, and I'm probably best known for turning an account with less than $600 into more than $12.5 million of verified and independently audited trading profits. Now, I share that with you not because I want you to assume that my results are typical, but because I want you to know that the person that you're spending time learning from today actually knows what the heck they're talking about. So with that said, I hope you subscribe to the channel and hit that thumbs up. Now, this is the candlestick chart, of course, and so we're looking for a way where we can jump in and manage our risk. And just to give you some context, here are a couple other charts of stocks that I've traded on this day, locking up $11,000. This was a stock that was moving up, leading percentage gainer, biotech stock, pharmaceutical company with breaking news, squeezes up over 100%. That was up $11,000 on that day. Here's one, I'm up $14,000 on the day. Stock goes up over 200%. Here's a day I'm up $24,000. Stock goes up 400%. These are incredible moves. $30,000 on this day, $45,000 on this day. So how do I approach taking that first entry? It's using one of my favorite candlestick chart patterns, and that is the bull flag pattern. So on a bull flag pattern, we're looking for the stock to squeeze up very quickly, start to pull back, and then what am I looking for? I'm waiting for that first candle to make a new high. So right here, based on this candlestick chart pattern, what do we think is going to happen next? Well, if the next candle opens and is red, then the price could continue to decline, and I wouldn't buy it. But if the next candle opens and immediately begins to move higher and breaks the high of this candle right here, then that's the place where I'm a buyer. And so where do I get in? Right there. It's right the moment right there that this candle breaks the high of the previous candle. We call that a candle over candle formation. So when we're pulling back, candles are making new lows and they're dipping down. And one of the things that we pay really close attention to as traders are these moments where the price changes directions, these pivots. So we want to buy at the bottoms and sell at the tops, buy at the bottoms and sell at the tops. So we're always paying really close attention after something has made a big move to try to see where is it about to roll over. Because if I'm already in way down here, I want to make sure I get out while maximizing my profit, but without selling too soon. You don't want to sell too soon and you don't want to hold too long. It's finding that perfect exit. And then when it's pulling back and we're thinking about getting back in, we don't want to get back in too soon and have it keep selling off, but we don't want to get back in too late and have it go all the way up without us. So what we're paying really close attention to certainly are these candlestick shapes. But what we're going to do is we're going to add on that additional layer of using level 2 market data. Because what if, just for the sake of argument, what if as this popped up right here, let's just say right on this candle, let's say there was a 200,000 share seller right there. Well, if there was that big seller right there, then as this started to pop up, while the candlestick chart might have looked great, the level 2 would have told a different story. And the level 2 would have been a better predictor of what's actually going to happen, because it would tell us this is not going higher until someone comes along and buys 200,000 shares, and that's probably not going to happen. So essentially that person has created a wall and it's going to keep the stock from going higher. That's going to be a problem. So when we look at these candlestick chart patterns, the patterns by themselves tell us what we would expect to have happen as long as the level 2 data isn't giving us a big sell signal. So right here, we have 3 candles that go up, a candle of pullback, first candle to make a new high, that's the entry. And then we get that nice resolution as it moves higher. So in this case, there were no big sellers that were blocking the way, which is good. That is often the case, but it's not always the case. So here we get another move up, a little pullback, first candle makes a new high, and it surges higher, just like that. Here we get another one. Now, this is actually gonna be a pop quiz. All right, so right here, what would you do? We've got one candle pulling back, second candle pulling back, third candle pulling back. So if this next candle breaks what level would we be a buyer? The high right there. So that's where we'd be a buyer. Now, if it doesn't break that level, we don't buy. So we're sitting and we're watching and we're waiting. And it breaks. But now what if on the level 2, just before it broke, let's just say down here, there was a 200,000 share buyer. What would that communicate? That would give us a sense of there's some real support down here. There's a buyer that is almost propping up the stock. They're holding it up and creating support with that large buy order. So now if I want to jump in, I can cut in front of that order and I can just buy on the open market. And that's going to be really important to understand that the orders that we're seeing on the level 2 are all limit orders. Those are orders that people have placed to buy either on the bid or to sell on the offer. But at any time, you can execute what's called a marketable order, where you would get in at current market price. And so if you see a big buyer down here creating support, that's great. You can still jump in just ahead of them. And the way you would do that is by actually buying on the offer. So let me just show you an example of what that would look like. I'll show you with this stock right here. So Bank of America again. So here we go. This is the chart, or this is the level 2 window. So let's say I want to buy this. I'll pull up my order entry window. So if I want to buy, there's two ways that I could buy. One way would be to buy right here on the offer at 42, right? If I click that buy button, what's going to happen? I'm going to instantly fill 2,500 shares. Now, I'm probably in slightly between the spread. If we actually looked at the execution down to the decimal point, I'm probably in slightly between the spread. But just for the sake of argument, let's say I'm in right there. Now I'm going to go ahead and sell right there, and I'm back out at 41. So I bought at 42 and I sold at 41 approximately and lost $12. Now, what if instead I want to buy at 41? Now, if I want to buy at 41, I can make my order visible, 2,500 shares, which by default most people will do. And by doing that, I'm going to place the order, and my order is now sitting there right there at 41, right? So now I filled a little bit of shares. Someone came and sold me some shares. Now I might have to wait. I might have to be patient. But if you're placing a large order, a lot of traders and investors will place their orders like this, so they can be patient and then get in at the exact price they wanted. Now I'm going to cancel the order, and then I'm going to turn around and place the same order, 1553, on the offer. Now it just so happens the price is dropping a little bit, but that's okay. Just for the sake of argument, I'm going to place the order to sell right there at 43.40. So now I place the order on the offer, and now what do I have to do? I have to wait. I have to wait until someone comes and buys those shares from me. And it might take a few minutes. But if you had a really large sell order, why would you sell like this? By putting your order on the offer. Well, what you might not want to do is sell on the bid. Because if you sold on the bid, typically, and it's a large order, the price will drop. And so if you have a large order, you're typically going to buy on the bid or sell on the offer. That's typically the way people are going to do it. So here I move my order down to 38, and I'm going to have to keep sitting, keep waiting for someone to come and buy those shares. So let's say all of a sudden here we saw a 200,000 share seller show up at 38. That would tell us this thing has a big wall of resistance. It's probably not going to go up. Or if we saw this big buyer pop up right here at 35, that would give us some conviction that there's someone else that likes this. So I'm going to go ahead and get out of this trade, and I'm going to sell right here at 36 and take the loss. So I don't mind losing $90 or whatever it is. This is a demonstration just to kind of help you guys better understand how level 2 data works. So now let's jump back onto this pop quiz. All right, so now we've got a chart where we've got the price moving up very quickly. We've got a ton of green candles in a row. It pulls back, and then what are we looking for? The first candle to make a new high. And boom, there it is. So that's our entry point. Now, as long as we don't have something on level 2 that's telling us no, the candlestick chart would be confirming that this is the place to buy. So for me, I'm using the candlestick charts to help me understand where I want to get in or out. And that's why I said that if I just pull up the level 2 data, I can't do anything with that. This is price with no context. Is 43.36 good or is it bad? I don't know. There's no context around it. So I need to have the candlestick chart. But you can have a great looking candlestick chart and the setup still doesn't work. And that's because of the big seller. And I've seen so many traders who will buy into that type of setup. And I'm like, guys, there's a huge seller blocking the way. Why are you buying? We've got to wait for that seller to move, for either for someone else to buy their shares or for them to cancel the order. But the fact is, this setup's probably not going to work because that seller is there. Even if someone does come in and buy their shares, who knows? Maybe this same person is going to sell more shares and keep selling all day long. Sometimes we do see that. Whether it's an insider that's selling shares or a long-term investor that's been holding, we don't know. But the presence of those really large sell orders is not a good thing. On the other hand, the presence of really large buy orders, that could give me the conviction to size up and be even more aggressive. Therefore, using level 2 allows me to make more on some of my best trades and lose less or potentially avoid unnecessary losses by not taking trades at all when I see, even though the candlestick chart looks good, those really big sellers popping up. So right after we get into a trade, we want to see strength, right? So if this is popping up, it's squeezing up, pulling back, pushing higher, pulling back. We get in right here, and right after we get in, what do we want to see? Big green candles, right? High volume buying. That would be fantastic. And of course, for the price to be moving up. So large green candles, price moving up, and big buyers. In other words, what don't we want to see after we buy? We don't want to see large red candles. We don't want to see the price going down, and we don't want to see big sellers. But here's the really interesting thing about those large red candles. By the time the large red candle has occurred, the price has already dropped, right? So if we pull up the whiteboard here, let's draw it out. The price is moving up nicely. We've got a couple of nice big green candles, and then we get a little bit of a pullback here. And let's just say we're watching this to make a new high. And then suddenly, right up here at the very top, we got in, and then we come up here, and there's a 500,000 share sell order. That's a huge wall. And so what's going to happen is the second the price comes up to there and everyone sees that sell order on the level 2, they're going to bail out. And so you're going to end up having a red topping tail and a big red candle. Because people bail out because all of a sudden they lose hope in this setup working. Now they think if they got in down here, this is not going to go through a new high. And now with all the longs bailing out and selling, who else is selling? Short sellers. Because short sellers say, wait a second, this is a level of resistance. So if I short this right here, as long as this seller stays put right there, then this is going to keep going lower. And I don't have to worry about taking a big loss. Basically, it's the inverse of if we got in this pattern and we saw down here, we'll use the brown, we saw down here the 200,000 share buyer, right? The 200,000 share buyer down here, that gives me the confidence as a long bias trader to be even more aggressive, to buy an even bigger position for a bigger move up, because I know that even if I have to get out, I've got this person that I could sell to. In fact, maybe I could even buy 200,000 shares, because if I got in with 5 cents of risk, I can turn around and sell those shares to this person right here. So that creates a backstop. Now, I'll tell you, it's not a guaranteed backstop because they could cancel their order and it's gone. So you still have to be a little bit thoughtful of that. But the practice of placing orders and canceling, placing and canceling with the intention of trying to move the market higher like this is an illegal practice. So if a trader or an investor was doing that, they would end up getting their account banned. So, the algorithms can detect when someone's doing that. So that doesn't happen very often. Yes, it could happen. And I understand why someone might say, well, someone could just place that order to get everyone to buy, but you're not allowed to do that. And so it really doesn't happen that often. It's not that it never happens, but for the most part, I trust level 2 data. I take it at face value that if there's a 200,000 share buyer, someone clearly has a large enough account to place that order and most likely is trying to buy. So before the large red candle even occurs, we can see that big order on the level 2. So now let's begin breaking down each of these components in the level 2 window. There's going to be a bit to cover. All right, so what have we got going on? Well, right here in this column, and you can see this is it's not mirrored, but these are both the same. So on this side right here, we have the bid. So this is where all the buyers have their orders placed. And on this side, we have the offer. So we've got the bid and we've got the offer, or sometimes we call it the ask. Now, on the bid, on the left side, we have each of these symbols. Well, there's the symbols, they're letters. They reference the exchange that the order is being placed on and the route that it's going through to the market. So ARCA, BATS, EdgeX, NASDAQ, MEMX, MIAX, EDGE A, BATY, so on and so forth. So these are the different exchanges that traders use to execute their orders. Now, if you're using a broker such as Charles Schwab or E-Trade, what you're going to use when you're placing your order with them is what's called a smart route. And so when you do smart routing, your order goes through their sort of algorithm and gets sent out to the market, but it goes through what's called a wholesaler, which is an intermediary. So you don't have control over actually which exchange your order goes to, unfortunately. But if you're using a more sophisticated broker like Lightspeed Trading, for instance, or even Interactive Brokers or TradeStation, you can select which route you want to use for your order. Now, the reason that I like to choose a specific route is not because I see that it's the route that has the best price. You could say, oh, should I send to ARCA because it has the current best price if I'm going to sell, or should I send to BATS because it has the best price if I wanted to buy these shares? And that's not necessary because of a regulation in the market, which states that even if you sent your buy order to NASDAQ and their best order is at $9.11, they have to reroute your order to whoever is currently posting the best price. And so your order would just go over to BATS and it would happen instantaneously. You wouldn't even notice any latency or any lag from your order getting sent over to BATS. It happens so quickly. So for me, for my practice and for my trading, I just use NASDAQ as my market maker. So all of my orders go through NASDAQ. So in a way, you could almost live without this column. It doesn't really serve a lot of purpose for me. However, it's not something that most platforms allow you to remove. So it's just there by default. So it's good to know what it is, but it's also not really that helpful. And I don't actually do anything with this information. So I don't spend time looking at that column or this column right here. But the column in the middle of price, I certainly do pay close attention to. And so I'm going to walk you through the coloring and why they're green and red and yellow and blue and gray in a moment. But what we have here at the top is the current best price. So on the left, we have the bid, which is $8.91 in this case. So $8.91. That is the highest priced buyer. So someone right now says, I want to buy this, but the most I'm willing to pay is $8.91. Now, if you wanted to buy right now, you could put an order at $8.91, but you'd have to sit and wait for someone to sell your shares. But wait a second. Over here on the offer, there is someone selling shares. And the lowest price seller right now is at $9.03. So if you wanted to buy and you didn't want to be patient, you want to get in right now, this second, well, you can buy at $9.03. So you're going to pay more than if you sit in and you're patient down here, to the tune of 13 cents a share or 12 cents a share, right? So $8.91 up to $9.03. And what we call that is the spread. The difference between the bid and the offer is the spread. Now, typically, lower price stocks will tend to have tighter spreads, and higher price stocks will tend to have bigger spreads. That's not always true. There are exceptions to that, but it's typically the case that the lower the price, the tighter the spreads, and the higher the price, the wider the spreads. So when you have a wider spread, it does create a little bit more risk, because if you buy this right now at $9.03 and then immediately turn around and sell it, you're already down 12 cents a share instantly, right? So if you had a stock that had just a 1 cent spread, for instance, you could get in and turn around and sell it for only a 1 cent loss. And that would be much more manageable. So when you start to get higher priced and bigger spreads, you start to carry more risk, and that's the nature of trading. Now, on the other hand, high risk can at times mean high reward, and this is a stock, as you can see, that's up 492%. So this is a pretty huge move on 69 million shares of volume. So was it worth it? Was it worth trading it in spite of the spread? I think the answer is yes, but you have to decide for yourself. So we've got the price in the middle, and then what we have on the next column are the number of shares that person is trying to buy or sell. And what most platforms do, just to make it easier to read, is they drop 2 zeros. So this is 100, even though it only shows 1. And this is 2,000, even though it only shows 20. Now, I know it takes a second to kind of get used to, but you get used to it pretty quickly. And there are some platforms that include the zeros, but it sometimes becomes a little congested and hard to read, especially if you have a stock where you're regularly seeing 30,000, 75, 100,000 share orders or higher, because then you've got a lot of zeros. So we've got the exchange that the order is going through, the market maker. We've got, and I'm saying exchange because that's kind of the easiest way to understand it. It's technically an ECN, the market maker. The exchange would be NASDAQ, the New York Stock Exchange, or Amex, American Stock Exchange. But anyways, for the purposes of keeping it simple, I'm using that phrase. Then the price is in the middle, and then the number of shares is on the far side right here. So what I end up spending a lot of time looking at when I'm in a trade or when I'm about to take a trade is the spread, the size of the current buyer, and the size of the current seller. Now, if we look at 890, you'll notice that there's 4 rows that are all the same color. And that's because there are 4 buyers all at the same price. So 890, 890, 890, 890. Now on this side, there's only one order in that same red color, and it's because there's only one seller at that price. So these colors are based on the number of tiers away you are from the current best price. The best price is green, the second best price is red, the third best price is yellow, the fourth is blue, and everything beyond that is gray. So this actually communicates something interesting because in the 4 tiers closest to the market, there's a lot more buyers than there are sellers in the 4 tiers moving away from the market, moving up. So that visually shows a balance. And so what I see there is that there's more buyers than there are sellers. And that's a good thing if we have a long bias. Now, if we pull up something like Bank of America, this is fairly evenly balanced. The buyers on the left and the sellers on the right. You can see it's fairly evenly balanced. EDBL, this one's fairly evenly balanced at the moment as well, but it's got 100 million shares of volume. It's certainly very actively traded. It's up 56%. So it's up a fair amount, but not as much as perhaps other stocks today. So you can see that, the 2 orders both at 61 are both in green. Now at 63, then only one at 65, 2 at 67. So when we're watching level 2 in real time, that's when a lot starts happening. You're seeing the prices moving. And so where does the eye gravitate towards? Right here. This is where I keep my eye. Because I'm thinking about, of course, the price going higher. And so I'm looking at the seller. And how big is this seller? Because this is ultimately the person that's holding it back. Now I'll glance at the bid, and if I see a large order pop up, I'll notice it pretty quickly. My eye is usually sort of spots that fairly quickly. But otherwise, I'm watching the sellers here, and I want to see lots of buyers, which are the transactions that go through right here on what's called the time and sales. So we want to see these orders going through fairly quickly. And this, again, is how we kind of understand the difference between the charts, which are very historical in nature, and then the level 2, which is really showing us the future. So the chart, this is all the stuff that's already happened. These candles are now a permanent record for this chart. It's going to be this way forever. It's never going to change. Those are permanent candles. It's a historical record. So if the candlestick charts are historical, the level 2 is the future. I really would say that. Now, it's true that a candlestick chart does give us some level of prediction over what's going to happen next. When you have a price that makes the move up very quickly, or you have one of these very traditional patterns, what we're doing is we're doing pattern recognition all day long. So as traders, we're saying, well, I often notice when I see this and this little pullback on a really strong stock that this is an area where people come in and buy it. So you start noticing that, and then that pattern almost becomes self-fulfilling because the more people that see it and believe it and recognize it, the better it works. This is just like traffic signs, right? Stop signs work not because they're one color or another, but because people respect them. They've come to understand what they mean. If nobody respects them, then they don't work anymore. And so candlestick charts are sort of similar. They are the patterns become predictable, and then they work because traders believe they'll work. And they work because they make sense. It makes sense that after the price moves up very quickly that you would have a momentary pullback where some people might take some profit, or maybe some early short sellers try to establish a position. And then if it holds up, then it goes for the next leg higher. And so all markets, it really doesn't matter what they are. They don't go just straight up. That doesn't happen. It's these sort of waves higher. And so our goal, therefore, is to try to buy, at the lowest price without getting in too early, and then to get out at the best price without either selling too early or waiting too long to sell, because then you're selling on the way back down. And that's not what you want to be doing. So now level 2 is the future. Now, if I pull up my level 2 window right here, just to give you another demonstration, and I'll just move this to the side just so it's not overlapping here. I'll just push this over here. So on my level 2 window, I do have the ability to go in and adjust the settings a little bit. So if I go into the settings, I can actually go to design, level 2 design colors, and I can change the colors. So if I wanted to change the colors completely differently, I could, but this is the way most platforms will display level 2 data. Some platforms, so I'll show you just for example, Charles Schwab here just for 1 second. So Charles Schwab is a real kind of pain in the butt. So Charles Schwab on the Thinkorswim platform right here, so they show level 2 a little bit differently. So it's right here. This is the level 2 window. And you can see it's all a gradient. It's a blue gradient. I can't stand that because it's harder for me to visualize the tiers and to see that imbalance between more buyers or more sellers. So they do this gradient and there's no way to change the settings on it. So if you went into trade and then active trader and you went over to level 2, I find it very difficult to read. I don't like that so much. Now they also have the ladder here, which is essentially taking level 2, and instead of having it side by side like this, it stacks it on top of each other. So all the buyers are right down here, and all the sellers are right up here, and the best price is right there in the middle. Now, I don't like that so much either. You can sort of visually see the volume and sort of how it's displayed, but this is not intuitive, and not very many people use the ladder for active trading because it's just not, and they don't even display it very well. You can't even really see it very well. So most traders, even if they're using Charles Schwab, will end up using a third-party trading platform that APIs with Schwab that looks a little bit more like this right here, which allows you to very, very easily see these important signals on the level 2, to change your font, to make it bigger, really just to be able to get a good hang of it. Now you can see right down there, do you see the 311s? So the 311s there is an 11,000 share order. So that's a slightly larger buy order right there. Now it's not, and now they canceled it. Now it's not the largest buy order we've ever seen, but it's a little bit of a bigger buy order. So that's something that I pay attention to. So they're down there at 53, right there, down at 53. So on MEMX. So you see, all right, so maybe there's a little bit of support down here. Now, on a stock that's got 100 million shares of volume, a 10,000 share order is not really significant. 100,000 shares is significant, but 10,000 shares, nah, not really. Percentage-wise, it's a very small piece of the volume, so it's not something that I really would pay a lot of attention to. So what my eye is looking at is the level 2 right here, specifically the ask. So that's what my eye is pinned to, and I see those bursts of green, and that's what I love seeing. Bursts of green like that, and the price should move up. Now, that burst of green and the price moving up will then translate to the candlestick forming. But what happens first, the candlestick or the price? It's the price. This is where it happens first. And then the candlestick chart records it. Now it happens practically simultaneously. It's almost instantaneous, but it's important to understand this relationship between the current depth of the market, and which is level 2, and that candlestick chart. So right here, and we could do a 10-second chart. So I'll just zoom in here on this 10-second chart. So this is our 10-second chart, and this is going to be our level 2 window right here. So just move this over. So what happens here is now we're seeing 66, 67. The candlestick chart is showing that price, which is the last price that went through the market. But the true source of this data is right here. This is the source of the data, the level 2, and then this record right here, which is called the time and sales. So I spend most of my time staring at the level 2 right here, at the ask, at the time in sales, and then glancing back at the chart. So even right now, I would say this might be the beginning of a micro pullback. Now, granted, it's on a 10-second chart and not at the time of day that I would typically be trading. The 1-minute chart is showing this larger topping tail back here. That's bearish. The price on this moved up nicely earlier and then dropped pretty hard. So I don't really think that this is a pattern that I would consider trading right now. But if I was going to start to get dialed in on it, I'd be looking at the candlestick chart. But before I take the trade, I'd be pulling up the level 2 right here. So now let's get into this demonstration. All right, so this is going back to this stock that was up 88% on the morning on this particular day that I traded it. And this is a demonstration that I recorded, so I'm going to play it back for you. And this is a stock that, by the way, is a little bit more thickly traded. So stocks can be on the spectrum of being either thinly traded or thickly traded. So let me just show you an example of that. And I think I already mentioned this, but the time and sales window is this window right here, which shows every transaction that's been placed. Transactions that are in white are orders that occurred between the spread. Transactions in green occur at the offer. Transactions in red occur at the bid. So what we like to see is a stream or flow of buying in green, right? Because that would be buying at the offer, buying at the ask price. So if we move this back over, this time and sales window, and this is just a bigger version of what's sort of already right there. You could just pop out a second one, so it's even bigger. But this is showing every transaction that goes through. Now, in the old days, investors could subscribe to and use a ticker tape machine. And a ticker tape machine displayed a printout of the current price of the last orders that went through the market. And it communicated almost like Morse code through the telephone line, and the ticker tape machine would print out every transaction. And so if you ever saw that movie, All the Money in the World, about John Paul Getty, I think that was his name, he, in one scene, is standing in this sort of dark library holding this reel that's going, it's printing out the quotes of the stock. That's when his son was kidnapped, and he was like, no, I'm watching the money. And so anyways, in the older days, people in his situation, he would not have had candlestick charts, but he would have had the ticker tape. And so what he would have had from the ticker tape and from the newspaper, he would have known the previous day's closing price. So he would have known the previous day's closing price. And what he could have actually done, and this is what people did, is they would begin to graph out the actual price today. So they'd be like, oh, previous days, this is so old fashioned, but they'd be like, previous day's closing price was $40. All right. So then they're looking at the ticker tape and they're seeing these orders they're going through at 39 and a quarter, 39 and a half or whatever. So they're like, okay, the price is going down. And then they start to see the price going up, and then the price is going down, and the price is going up, and then the price is going down. And so they kind of create this graph, and old time traders would actually trade off of these handmade graphs of what they thought was happening in real time. And their source of data was the time and sales. They didn't have level 2 data. All they had was this window right here. Now, I will tell you that there are times that I have traded using just this type of data. And the only time has been when a stock does an initial public offering, an IPO. Because sometimes right at the moment of the IPO, there's so much data that charts stop working. This has sort of historically been the case. And so all you have is the price. And so when you have a really hyped up IPO like Facebook or something like that, where there's millions of people that are watching it, the second it begins trading, boom, it just bursts in volume. And so if you want to trade it in those first few seconds and try to ride that momentum, all you have to work with is the time and sales. So that means you're watching those orders that go through, and you're just keeping a mental sort of memory and record of what was the highest price. All right, it's dipping down. So now if it goes back to that level, I'm going to look for a squeeze through the high. So I just start thinking about what was the high, what was the low. And so in a way, I almost can trade without charts. And I have before, because on these rare occasions that charts go out. It wouldn't really make sense. There'd be no purpose in doing it, intentionally. You would just be trading with less information. It's not going to give you an edge by any means. But it could be done. And could I trade without level 2? I could, but my accuracy would be lower because I would miss some of the signals that this communicates. The bursts of buying, like right there, the bursts of selling, or the large buy and sell orders. So could I do it? Yes, but it wouldn't be ideal. Now, the spectrum of thin to thick markets is what I wanted to kind of mention here before we get into this demonstration. So a thin market is going to be typically a higher price stock, and you have a large spread. Look at the spread between the bid and the offer. That is substantial. That's a 3-point spread. Point is $1 a share, so 3-point spread, that's a $3 a share spread. $3.40, that's a huge spread. So if you bought this with 1,000 shares at 50, you're down $3,400 if you just turn around and sell it to this buyer right here. And that buyer's only buying 200 shares. So you might not even sell everything to them. The price drops, and now you've got to try to fill on the next level down. Or up here, if you want to buy 1,000 shares, you might not even be able to buy 1,000. You'd be able to buy 200 because there's 200 for sale, and then the price is going to go up. Now this stock is a little cheaper at $17 a share and has a 28-cent spread, 7 million shares of volume. So it's got a little bit of a tighter spread, but still a little bit bigger compared to this stock. This stock's got 48 million shares of volume and has a 7-cent spread. So now you've got, or a 6-cent spread. So now you've got a tighter spread, right? 7 cents. So a little bit tighter. And then here, BNZI, you've got a 1-cent spread. So now this is great. You've got a really tight spread on this one. However, at times you could argue that the spread could be too thin, the market could be too thin, and you could also argue the market could be too thick. When you've got a really big, big market, thick market, and a tight spread, the problem is that these stocks can be very congested and they don't move very quickly. Okay, so let's go ahead and jump into this demonstration. So the price as of right now is up 172%. Okay, that's a big move. And the pattern that we're working with here is a little bit of a variation of the traditional buying the first candle to make a new high, because in fact, it already did that right there. It pulled back, it made a new high, and it failed to go higher. Why? There was, at the time, a big seller right there at 280. So it went to 279. You could see the seller at 280, and it didn't break. It dropped down. So now as it comes back up again, I'm looking at this as being a level of resistance. And I'm asking myself, is that seller still going to be there? So I like the candlestick chart pattern. I think this has the potential to go higher. It's just come out with breaking news. It's obviously up a lot. Some would argue, oh, it's up 170%. How much higher can it go? And I would argue that it can go higher because when you've got strong momentum, these can really move quickly. So I'm bullish on it. I want to buy. I just want to see if that seller is gone. And I want to see what happens when it comes up to 280. So let's watch this right here. And I'm going to play it, and then I'll pause it and play it and pause it. So as we come up to 271, 272, there's 274, 275, and right there, the seller is gone. That's 10,000 shares. That's not the big seller that was there before. So what do? I immediately buy. I press the buy button, and I buy instantaneously. Now what ends up happening is I actually get filled a little bit above the current price. It actually already shows that I filled at 284 right here, even though my order hasn't yet gone through the market. Unpause it for a second, and there, that was my order, went through the market. And so now I'm in right now with 30,000 shares at 287. And I bought this because now I've got the confirmation that that big seller is gone. Now I don't mind paying 5 cents, 7 cents, or even 10 cents higher than the perfect price of 280 when I have confirmation. So I have confirmation. And what am I looking for now? The breakthrough 3. So I added, and I've got now 35,000 shares, and I'm already up $4,896.62. So on this, it breaks over 3, and I'm just kind of watching to see, do we have big sellers? And right there, just for a moment, there was a bigger seller. So let's just back this up. So we break over 3. We're looking good right here. And I decide to add because we're holding 3. So I add right there, and then there's a 26,000 share seller. Now that's a little bit bigger. It's not huge, but we've got only 20 million shares of volume so far, so that's a little bit bigger. So now I get a little nervous. That's a slightly larger seller, and I was hoping this would squeeze right up to 315, maybe 325, ideally to 350. So it goes up to 312, 313. You can see I'm up unrealized about $9,800. And I decide to take some profit, which is okay. I take some profit because it sort of hesitated up there. So if we go back to that peak, it came up here, and because I had just added and then it sort of didn't pull away, I decided to sell what I had added. So I reduced my position, and now I'm watching to see what it does up around 315. So there's 310, there's 312, 313, and right there it breaks, and I add back. So now I'm back in at 313, and there's 325. So on the 10-second chart, you can see that micro pullback. Now in hindsight, I probably shouldn't have sold it all. I should have held the whole position. But because I had added, and then I was sort of not up that much from where I added, I felt I should get out of the position. So now we're coming up towards 340 and 350. So I take a little profit. And the reason I do that is because what I know is that most stocks will have some resistance at $0.50 and whole dollars. So a psychological area of resistance, 3, 350, 4, 455. So as we approach 350, I took some profit off the table. Now, if this can hold 350, I'm going to add back. And I do. I add back here, and now I'm looking for a squeeze up to 365, 375, and back of the mind target would be 4. But did you see what we had right there in the 60s? So let's watch this. It pops up. I'm holding a big position on this. I put out a profit target order at 378. It pops up here to 360, 360, 378, and some of my shares get filled right up here, which is great. So I get some profit, and then watch right here. There's a 50,000 share seller at 365. And what I probably should have done was just sold the rest of the position. Now in this moment, how would I sell? I could put my order on the offer at 364, essentially put it right underneath this 50,000 share seller, but everyone's going to see that sell order, the 50,000 share sell order, and that's going to stop them from buying. So the best way to get out of this in this moment is to hit the bid and to sell at 364 or even 361, and that's what I end up doing. Now that sell order comes down to 360. So see, and now they're at 359. So that sell order is 358. That sell order is actually pushing the price down. That's a very specific type of order called a pegged order. It's pegged to the best, to the offer, to the ask. And so as the ask drops, as someone tries to undercut them, their order moves automatically to that lower price. And so the problem is that this creates a real wall of selling pressure that pushes the price down, all the way here down to 51, right? And down to 49, and down to, well, it looks like about 47, and then people started buying. So finally people started to buy and the seller's gone. But unfortunately at that point, I've already come all the way back down nearly to break even. And now there's another seller that came out. So in this case, that big seller at 65 was very clear writing on the wall that that's going to be the high. Now let's look at our candlestick chart. What's the shape of this 1-minute candle? In all that time, were you even looking at the candles? Perhaps not. You were so focused on the level 2, and that's what I often do myself. Once I first see the stock moving higher, and I've kind of understood, okay, this is support, then I'm taking my entry, and at that point, I'm actively trading it, buying and selling as it's moving higher. Now, some people might take the approach of just buying, holding the whole thing, and then waiting for the candlestick chart to say, I should get out. And the candlestick chart saying you should get out would be the topping tail forming, and then that candle ultimately closing. Now, currently the time is 7:30 and 47 seconds, which means we have 13 seconds, 12, 10, 9, 8, before this candle closes. So by the time you get your exit indicator, the price could already be down 30 cents or more. On a 30,000 share position, that's $9,000. So with a big position, you can't really wait that long. you've got to see the exit indicator sooner, and you've got to see the entry indicator sooner so you can be jumping in and getting out and really capitalizing on these moves. So in this case, by the time the candlestick formed and the exit indicator formed in that visual sense, you should have easily been able to get out much sooner. And so that's where level 2 is giving you that early edge. And now all of a sudden we're looking at the P&L and holy smokes, I'm sitting up $39,000 on the morning. $39,000. I went from $10,000 to $39,000 in about, 10 minutes? Happened very quickly. The stock went from $2.50 up to nearly $4 a share. And so just the candlestick charts alone wouldn't have given me the conviction to buy where I bought or to sell where I sold, which means if I was using only candlestick charts, my accuracy would be lower and I wouldn't feel confident taking as big of positions. And the net result is that I would make less money. Now, candlestick charts are your foundation. You need to know how to read candlestick charts. And then when you then study level 2, that's where you're kind of putting together the pieces of the puzzle, because the level 2 helps you better understand what is happening inside each one of those candlesticks, how those candlesticks are actually being created, and how your orders actually participate in the market. If you're going to buy 10,000 shares of this stock right here at $275, the price is going to go $276 because of your order, because you just bought all those shares. That's what you would expect to have happen. If you sell 10,000 shares at 74, the price is actually going to drop from 74 down to 73 because there's not 10,000 shares available there to buy what you're trying to sell. So the way your orders interact with the market, the way you read the time and sales, the way these candles are being created, this is the next level of learning how to trade. And as always, the best way to learn is to practice these new strategies in a simulator. That's the safest way to learn. So if you want to keep learning, here's what I'll do. I'm going to put a link. It'll be in the description of this episode and in the top comments where you can do a 2-week trial at Warrior Trading. During your trial, you will have access to my charts, my scanner, my news feed, and you can begin practicing trading the strategies that I trade every single day. You'll also be able to enjoy my real-time commentary. So you'll be able to hear me. You'll be able to see my positions window while I'm trading the market in real time. Now, if you need a refresher on how to perform technical analysis the right way, I'll put a link to one of those episodes right here. I'll put another long form episode over there. And as always, if you enjoyed and got value out of this class here today, I hope you hit that thumbs up. I hope you subscribe to the channel. And let me remind you, as always, that trading is risky. My results aren't typical, so please manage your risk, take it slow, and I'll see you for the next episode real soon.